So we're now getting housing market statistics for the month of June. This is 2 months after the events in April. Stocks are soaring again. Consumer confidence is higher, yet real estate is not. In fact, the data that continues to come in gets even grimmer, especially with the canary in the coal mine, Florida, putting up some pretty alarming results. And this is not about historically high interest rates, as you'll see. To begin with, mortgage rates aren't even historically high. They're not even all that high in historical context. That's the excuse everyone likes to use because it sounds right and because that's what every economist and every central banker will tell you, even though those are the last two categories of people anyone should ever listen to when it comes to anything in the economy. The truth is, we've had mortgage rates at roughly 6.5% to 7% for 2 years now, and there is zero threat that they're going to go higher. Back in the booming 90s, by contrast, real estate flourished and even started to go too far despite mortgages between 7 and 9% the entire decade. Something else is missing here. And that something else is missing more and more as 2025 drags on. We've got a lot more than trade wars and uncertainty to worry about, especially where it comes to housing and real estate. In fact, given the stats that keep coming up, the economy is becoming more certain, not less. We've got a whole bunch of real estate sector data to go over, and it's all going in the wrong direction. So if we are seeing a genuine bust developed, we're going to see it first in the state of Florida. And this quote from Florida really epitomizes that sentiment. Quote, "I think we are beginning to see the real pain in the condo market right now." Now, Brad O'Connor, who's the chief economist for Florida Realtors, told the Florida Roundup that condos are facing factors such as high mortgage and insurance rates, which have also affected the single-family home market. And then on top of that, they have association fees that are rising to meet new reserve requirements following the deadly Surfside condo collapse. But in terms of single-family homes, the pace of sales of existing homes compared to a year ago has been falling since February. And median prices have dropped by 4% in April. And that can prompt concerns about home values. But, quote, "We remain over 50% higher than where we were at this time in 2020. Still, 4% on the downside is the largest year-over-year percentage decline," O'Connor said. "We've observed for Florida's single-family home prices going all the way back to October 2011, so it's worthy of our attention." And there is that narrative, especially where it comes to Florida, that after a booming period, especially in the immediate aftermath of the pandemic, the state is just going through a normalization process for real estate and housing. After zooming way ahead, migration, a whole bunch of other factors, now it's starting to just cool off into something more normal and sustainable. Where have we heard this before? Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. But as Newsweek points out, the Sunshine State is experiencing some of the steepest price drops in the country as inventory surges while buyers are kept to the sidelines by historically high mortgage rates, and we'll see that's not true, rising homeowners association fees, and growing home insurance premiums. And I can at least attest to the last of those couple, they are absolutely happening. But the biggest factor here, those aren't the biggest factor, nor is historically high interest rates that I said in the introduction aren't historically high to begin with. There's something else going on here, and we can see it in Florida. Continuing with Newsweek. One of the biggest reasons for the slowness in Florida is the buildup in the inventory of new homes. That's according to Chris Porter, who's the Senior Vice President of Research at JBREC. Florida tends to have a heavy focus on spec homes. Those are houses that builders construct on the speculation that it will sell easily for a profit. And there is significant competition with many builders in the region, all competing for sales, he said. In other words, the buyers that builders were expecting to be there in Jay Powell's strong economy have ended up not being there. Significant competition means lack of buyers, not necessarily an oversupply of homes. It seems like an oversupply of homes, but only because expectations for demand by those builders hasn't been met, and it has increasingly been not met. So the big question here is, why? Where did all the buyers go to? So we've got more selling, and some of that selling might not be a good sign either. That might not be just because people are willing to move all of a sudden. In fact, it may be because there's a bit of distress there. But we've got more sellers and nowhere near enough buyers. And of course, Florida has some unique characteristics, and condos are a difficult sell, especially older models nowadays that have new regulations to pay for. And let me tell you, home insurance here is absolutely nuts, and the costs keep rising. And while everyone mentions interest rates, we'll come back to that one. So there's more of a bubble, housing bubble here and repeatedly out throughout history in Florida than most other places, especially in the post-pandemic age. Florida experienced a gigantic wave of migration, a huge boost in demand for housing, both to live in, but also as investments and in speculation. It was widely believed that the trend would stay like that forever. In fact, that's what happens in every bubble period. Everybody becomes convinced that it's going to go on and on and on forever. So even if there is normalization here in the Florida market, it's going to be a pretty extreme downshift nonetheless. But it's not just Florida. Yes, the state's unique characteristics make it stand out, but it's standing out at the extreme end of what is becoming an entrenched national trend. And it's the national data that's getting to be the most concerning because of what it truly implies. And I don't mean historically high interest rates that are not actually all that historically high. So what we observe of the national statistics, the data that's coming in, is that the national housing market itself, not just Florida is a big part of it, but the national marketplace itself is struggling. Just today, for the month of June, the Census Bureau reported that 2 months after April, we've got tariff deals, we've got a roaring stock market, consumer confidence is up off the lows, but yet the pace of sales was just 627,000 at a seasonally adjusted annual rate. That's just 0.6% higher from May, but May's sales pace absolutely plunged by a revised 11.6%. So you had the big downturn in May, and then no recovery, no rebound, no retracement here in June. And so you have the last 2 months, May and June, that are back at the 2022 lows. And the median sales price, not seasonally adjusted, $401,800, is down 1.4% from last June. And what we've been seeing consistently across the country is that home builders have been discounting prices for the last several years. And again, everybody says that's interest rates, but it's not really interest rates. So now in 2025, in the middle of this year, there are fewer sales and still lower prices and higher discounts. That's weak no matter how you look at it or where you think all of this is coming from. And with new home sales in this state, builders, unless they think something drastic is about to turn around, are going to be looking to cut back on their construction activity. And that's exactly what we see, especially in the single family segment. According to the Census Bureau and data that came out a little bit earlier, for single family homes, the number of permits that were filed in the month of June, just 866,000 at a seasonally adjusted annual rate. That's down 3.7% from May. And that is a whopping 30.3% below the peak set back during the immediate aftermath of the pandemic, back when the housing bubble was at its highest. In fact, at 866,000, that's the lowest level for single-family permits since March of 2023. And maybe more importantly, single-family housing starts, those declined by nearly 5% in June, down to 883,000 at a seasonally adjusted annual rate. That's 27.5% below the peak and the lowest since last summer. So what we see in the construction statistics, like the new home sales, is that construction fell off sharply with higher rates back in 2022, then rebounded late in 2023 and early 2024, especially with rates beginning to come down at the end of 2023 with the global bond market rally, not because of the Federal Reserve. Mortgage rates are tied to Treasury yields, not Fed policies. But it didn't keep going. There was a lull in activity last summer as we started to get more and more concerning economic data on specifically what matters here, before there was another rebound toward the end of the year, which we've been talking about. Some of that had to do with the Fed cutting interest rates and people's perceptions that maybe the Fed was going to drive rates lower, but there was also the artificial high in a lot of other ways as well. And we see that here in home construction. But since February, there's that month again, since February, construction and sales have slid all over again. If you want to stay on top of everything, all of these monetary and macro developments, Eurodollar University has a brand new subscription for you over at Substack. Every week, we're going to tell you what the one big theme is that you need to know about, and then dive deep into it, giving you all the background material from all across Eurodollar University's vast library of material about what's happening, why it matters, and what it means for the future. And you check out all the details behind that new subscription service, as well as some sale items on Eurodollar University memberships at our website, Eurodollar University. There's also a link in the description of this video to go right to Substack. And we can keep going. Beyond new home sales and new home construction, how about resales or the sales of existing homes? Yesterday, the National Association of Realtors reported that the total volume of transactions for the month of June was less than 4 million at a seasonally adjusted annual rate. In fact, they recorded it at 3.93 million, which was below expectations of just a little bit above 4 million and down from May's pace, which was already low at just above 4 million. In fact, 3.93 million is the lowest transaction volume for any month since last September. So round-tripping the artificial high and a very clear downtrend since earlier this year. That's continuing on into the middle part of 2025. And while the median home price for resales hit a record high in June at $435,300, it's only up 2% from last year, and the rate of change is slowing down even in the resale market, where there are still more buyers than sellers, even if inventories have increased overall over the last little while, though they were down in June. And because of all this, the weirdest thing is chief economist for the National Association of Realtors, Larry Young, a guy we pick on all the time, is actually starting to make a whole lot of sense. Here's what Young said for the June data. Multiple years of undersupply are driving the record high home price. See, that's absolutely correct. Home construction continues to lag population growth, and we'll go over at the end of this video why that is. This is holding back first-time home buyers from entering the market. More supply is needed to increase the share of first-time home buyers in the coming years, even though some markets appear to have a temporary oversupply at the moment. And that's the part that's our immediate concern. The temporary oversupply has to do with current economics, while the lagging home construction and the lack of homes that are available for people to move into has to do with longer run economics, and it rhymes with dilent suppression. But of course, Larry Young, as an economist, he falls back on his baseline type. Quote, high mortgage rates are causing home sales to remain stuck at cyclical lows, and that's not the case. If the average mortgage rates were to decline to 6%, our scenario analysis suggests an additional 160,000 renters becoming first-time homeowners and elevated sales activity from existing homeowners. So as usual, Young is blaming high interest rates because he's an economist. He's an economist working for realtors, and so what else could it possibly be? But it's not interest rates. Just look at the data that we have. There was initial shock in 2022 to the housing market lasting into early 2023. That was definitely about higher mortgage rates. That was the initial shock. Rates went up and everybody pulled back from the housing market. Resales went down sharply at that time, as you would expect. But they only rebounded by a tiny amount in early 2024 as rates started to go down again. And then resale activity fell last summer, but then came back, but only a small amount in late 2024. That was the artificial high. The Fed started cutting rates, as I just said, leading to the perception of rates were going lower. But then early 2025 to the middle part of the year, transactions are rolling all over again, even though mortgage rates haven't really gone anywhere. And to show you why it's not interest rates, let's go back to the 1990s. The 1990s, a legitimate economic boom, and the real estate market, after some rough times at the start of the decade, truly did flourish. There was a big drop in sales and construction activity in the early 1990s, but that wasn't because of high mortgage rates in the late 1980s. In fact, sales and construction fell sharply despite sharply lower mortgage rates at the time. The average 30-year mortgage went from above 10% in 88 and 89 down to around 7% by 1993. The decline in real estate was driven by, first of all, the S&L recession, but more so the S&L crisis, which precipitated the recession, meaning the lack of credit availability. People don't realize how much that savings and loans were responsible for mortgages. But once both of those were taken care of, the S&L crisis and the S&L recession, home sales and construction picked right back up in the early 90s, even before mortgage rates got to their ultimate lows. And then the market didn't crash when mortgage rates soared to 9% in 1994. There was only a moderate slowdown. And after that slowdown, it kept right on going, right on through the end of the decade. In fact, it continued to accelerate through the end of the 1990s. And for the entire decade of the 1990s, the average mortgage rate was between 7 and 9%, and the real estate market continued to be robust the entire time. Why? What is the answer here? It's basic economics, not interest rates, jobs, and incomes. The 1990s was a legitimate economic boom, maybe the last legitimate economic boom that we've seen. People were not afraid of jobs. In fact, jobs were flourishing, opportunities were flourishing, real wages and real pay continued to grow year after year after year, and people were supremely confident about that. So even though mortgage rates were 7 to 9% through the entire decade, income growth, job opportunity easily absorbed high mortgage rates. The economy was strong and robust, not the garbage strength that central bankers talk about these days. The truth is, mortgage rates have been moving lower, even if not all that much, for going on 2 years by now. They're below 7% for the most part, whereas in the 1990s, rates were almost always significantly above 7%. So if the economy here in the 2020s was even close to being solid and healthy, that is more than enough time for the economy and people in it to have adjusted to this level of borrowing costs. There was the initial reaction that was understandable, the downturn in late 2022, early 2023 because of interest rates, similar to the slowdown in 1994. But after that initial correction period, buyers should be coming to grips with higher interest rates. Here in 2025, they should be everywhere, confidently betting on solid incomes and favorable job prospects, understanding that they'll be able to absorb our current, quote, historically high rates that aren't all that high. I mean, no one likes to pay more for interest, but you take what you can get and move on. And so the real reason housing seems to be unaffordable is that the labor market is not robust, it did not recover, and has produced too little income to make everything, not just houses, reasonably attainable. So if the real estate market is shifting downward again, it's not because rates remain near where they've been for 2 years running. Prospective buyers are sitting out, worried that they won't be able to afford a house, a car, food, insurance, all the living expenses, and then still hope to have some money left over for fun things like vacations and leisure. There's just nowhere near enough income for all of that, and people are rightly concerned that there'll be even less for them moving forward. But home prices would be getting cheaper if not for the longer run economics, which have suppressed building and really buying ever since, 2008. We don't have nearly enough homes in this country, and builders are not building nearly enough to absorb what would be legitimate demand, all because of QE. Again, as Larry Young, NER's chief economist, said, multiple years of undersupply are driving the record high home price. Home construction continues to lag population growth. And why is that? The lack of housing stock is actually very easy to explain. Yet regulations and red tape, unfriendly zoning, and often hostile communities, that's part of it. That's certainly a big problem. But the bigger problem is money. Mortgages, lack of banking, and then, of course, related to that, lack of jobs and incomes. Mortgage credit capacity was absolutely wrecked in 2008, and no amount of QEs ever brought it back. This is another of those dirty post-crisis truths the Fed doesn't want you to know because it exposes the fraud that QE was. All of that supposed money printing and mortgage credit remains in the trash almost 2 decades later? No, banks were broke and they were never fixed. Plus, because the monetary system broke the banking system, the deflationary effects, the long-run deflationary effects, as Keynes said 100 years ago, hit the labor market the hardest, meaning even if banks wanted to lend, they would have a harder time doing so because the lack of income during the 2010s and now the 2020s would have made it impossible for them to extend mortgages in broad fashion like we need them to. So, okay, some people will say Florida's housing market is just normalizing after an ultra-frothy period during and immediately after the pandemic. Maybe, but the national marketplace is showing the same cracks, even if they're not quite as visible. So everyone will simply blame historically high interest rates that aren't historically high. Rates do matter, especially in real estate, but what matters most, by far, is employment, jobs, and incomes. So if there's really a national bust that's developing here, it won't be because of the traditional credit-fueled bubble that everyone imagines when you use these terms. Instead, it will be because the economy did not produce enough incomes both in the 2010s and now in the 2020s, and now more and more people are afraid there won't even be enough jobs. The ECB's bank lending survey for the second quarter showed that European banks are tightening the screws on consumer loans, which means European banks are concerned about jobs and income. Same there as here, and all the details in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's subscription at Substack. Huge thanks to Eurodollar University members and subscribers, and until next time, take care.